Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're just going to do another Velocity Banking review. And it is Sunday. I literally just woke up, but I figure that I just crank out another Velocity Banking video before I step outside my house for some Sunday activities. And we'll declare today to be Sunday Financial Freedom Day. In fact, every day is Financial Freedom Day in this channel. So let's go ahead and review that thing called Velocity Banking that we will always review. So, what is Velocity Banking? Sometimes we call it the financial red pill, sometimes we call it a financial cult. But really, all it is a debt payoff strategy where you throw all of your money into debt with the help of something called a line of credit, right? And what is a line of credit? All it is a financial tool where you could borrow money, pay it back, and then use it over and over again, right? So, credit card's a line of credit. You want to see how many lines of credit that I have? I got a gajillion of them. Okay, actually, I have 26, right? 26 lines of credit equaling $594,000 of credit lines. And people try to come on this channel and tell me, you don't know what you're talking about. Yeah, sure I don't. I'll just stare at this. And you know what else I'm going to stare at when people say that? Paid off mortgage in 2 years and 9 months. I'll just stare. Like, yeah, I don't know what I'm talking about, but let me stare at this paid off mortgage in 2 years and 9 months. And the more I stare at this, or the more you stare at this, the more my ego meter gets fed. It's like a video game. Stare at this more, I get a maxed out ego, right? But let's not talk about that for now. And let's go back to the Sunday Financial Freedom holiday or whatever we call it, festival. Oh, by the way, did you know that this channel actually let me let me just do this. If I type in Korean ATL, right? Mentorship beats the festival and the consulate. Oh, that's hilarious. There's no physical location for this. It's literally just YouTube, but we beat those institutions in the in the Google rankings. Do it on a what's it called? Google Incognito. Anyways, what am I talking about? Well, there's really only 2 things to do for you to do velocity banking, 2 requirements. Number 1 is a budget. So you see we have a budget right here, 5,500 of income, 53,000 of expenses or 5,400, and then $100 left over in savings, right? And then in your expense breakdown, you have to list every single debt that you have because the whole point of this is pay off debt. And then once you paid off debt, okay. Once you paid off debt, ideally the only thing that should remain is your general expenses, with which is things you have to pay for every single month, food, gas, insurance, right? You got to pay for all that, right? Okay. And so what we're trying to show is that even with the same income, right? We have the same income and same expenses. We're going to do something that most of the American condition is to do is conditioned to do the exact opposite of, which is save money. Like, we're not going to save money. I know it's crazy, right? We're not going to save money. You see this line? This is like the savings right here. And a lot of people freak out about this. Like, I think I'm doing better here because I'm at least saving $101. But what if, okay, what if we got this number? Okay. Actually, this is wrong. We got this number, 101, and we increased it by not saving money. We call it our cash flow. I know it's crazy, right? Here in this column, cash flow and savings are kind of the same in the average American way. And then here, when you do velocity banking, they're two different things because you're definitely not going to save money. And so if you take a look here, this is my checking account, and as you see, when money comes in, I don't save any money, and then as expenses go out, I don't save any money, right? And that's what we're going to do with Velocity Banking. And by the way, take a look at my $280,000 home equity line of credit. Wow, home equity line of credit. All right, so now let's assume we have access to $100,000 um, line of credit, right? So we'll say $100,000, 9%. And let's see how much credit card debt we have. So this is 530.31, 530.31, and then I'm going to sum it up. And 66. All right. So guess what happens here? And then our credit cards go to 0, right? Because we're just simply doing a debt transfer. So the debt is not gone. But when we move into the line of credit, look at these, right? Wablam. Okay. So how do we go from $101 of savings to $0 of savings to $2,234 of cash flow? What? I was so proud because I was like, I'm saving at least $101, but once you see this, it's like, whoa. It's like Neo in the Matrix. I can dodge bullets? No, Neo. When you're done, you won't have to, right? And so now, all right, so let me just kind of explain this. So what's the difference between the average American and the velocity banker? Well, with the average American, you get paid from your paycheck. You pay your bills out of your checking account, and then you leave the leftover in your checking account, essentially. So your checking account is your main operating account. Somehow it makes an acronym of moo. So I put that there. And I put some cow emojis there to represent that, yes, this is your main operating account, aka the moo. Okay. And then here, it's your line of credit. So what does that mean? Is that when you get paid into your checking account, you just dump all of it into your line of credit. And then once you have expenses out, you just take it out of the line of credit, put in your checking account, and then you rinse and repeat over and over again. So after every single month, the cash flow um, is used to reduce the balance of the debt. And let's go ahead and do this, which is I2 plus 1, G2 plus H2 minus our cash flow, which is, what is it? 2234.16, 2234.16. And then what we're going to do is take the average daily balance, multiply it by the interest rate, which is multiplied by 0.09. And you see that's $5,000 of interest at a 9% interest rate. But don't worry, we divide by 12 because it's actually calculated monthly. And then we just copy and paste. All right. And then so now we do this, and then we do this right here at 34 months, okay? 34 months, and then we paid off 66K, right? Whew, sweet, okay? And then we have these 3 loans right here, okay? 3 loans, and then luckily we have a loan calculator to figure out at 33 months what's the balance of these loans, right? So we just do that, and then you see right here, yeah, these are the 3 loans. If you can construct your loan calculator, you can get the latest balance of the loan. I'm sorry, not determine. Given that you have the interest rate, the original balance, and the current month, and also determine the years, right? All right, so now let's go ahead and do this. So we have this thing called the cash flow index. I'm not going to go too much into it, but basically think of this as a ranking system. The lower the number, the more bang you get for your buck in terms of cash flow for paying off debt. So, for example, would you pay 189 grand to get $954 back in your cash flow, or 9 grand to get 386, right? I'd pay this off first because it gives you more bang for your buck, which we're certainly going to do, right? I'm going to copy and paste this, and then this is going to be plus 9970.18, and then this is going to be 0. Okay, so 2,620 and 91, and then this is going to be 2620.91. Wait a minute, did I screw up? I think I did. All right, I put the point in the wrong place. All right, so 38 months till the car loan is paid off. Pretty sweet. So 38 months. And then this is going to be 66 plus 21. 87K. 87K, okay? And then now let's go ahead and get the student loan out of here at 38 months. So this is 0 and then 38, okay? Now, we're okay with moving the student loan into the line of credit. It's actually, here's the thing. If you want to know the safest way of moving a loan into a line of credit, just do it in chunks, right? Especially if there's an interest rate difference. Um, so actually, let me pull out the Velocity Banking calculator. Give me one moment. All right, here we go. All right, here we go. All right, so now, okay, all we gotta do with this Velocity Banking calculator is type in the details, which is how much is it right now? 40,000. The current balance is 29417.69. The interest rate is 5%, 10, and then the payment amount is 424.26. 424.26. And then what is our income? It's 5,500. And then our expenses is everything except for the loan we're trying to pay off. So it'll be these two right here. And then I'm going to copy and paste this. So 2454.83. So it'll be 2454.83. Okay. So we see that it pays off in 0.9 months. Now, what if we had moved the entire thing into the line of credit? I have a feeling it'll be a couple $100 more, but let me just see that. Yeah, it'll be like $300 more. So you don't like in this case, like a couple $100 isn't a big deal, but you'll notice in the case of a 30-year mortgage, moving an entire loan into a line of credit is no bueno. All right, so let me just go ahead and do this. So it's be 0.9 years, and then this is going to be 38 plus 0.9 times 12, and then it's going to be 49 months. All right, 49 months. This is 0. And then this is going to be 127K. And then so now, actually, what am I doing? I just blanked out. I know, I'm kidding. I didn't blank out. All I gotta do is go 49 months here. And then just do the same thing here, right? So this is going to be 30 years. This is going to be 4%. I'm just going to do this, this, and this. And then what's our mortgage? It is 954.83. Yeah. 954 point. Actually, that's not it. What am I doing? 954.83. And then the living expenses is, I don't even know what my actually, no, I'm just kidding. It's right here. 1,500. 1,500. And then what is the current balance? 210, 210, and then right here, which is 184,689.04. 184,689.04. And then this one, 4.2 years? Oh, wow. That's almost as impressive as me being a narcissist and looking at my mortgage paid off in 2 years and 9 months. Almost, right? See how skewed my frame of reference is? How skewed my perception is? 4.2 years, oh, that's pretty good. But not as good as 2 years and 9 months, right? All right, so let's take a look here, and I don't even know why I'm here. No, I'm just kidding. 4.2 years, but it's because I'm super sleepy, and I figure better to crank out a video, crank one out before I leave my house today, and then this is going to be 49 divided by 12 plus 4.2. I think it's 4.2. So that's 8.28 years, and we're debt free, boys and girls. All right. So 8.28 years, I think that's 341,000, maybe a little bit less. But actually, let me go ahead and calculate this. It's 127 plus 210. That's 337 today. So 337. All right. It's called Financial Freedom Sundays, right? Financial Freedom Sundays. Beautiful. All right, well, that's it for today, folks. This is Creating into Mentorship. I'll see you all in the next video. Have a great day. And should I crank another one out today, later today? I don't know. Maybe I'll just be asleep all day because I'm a little bit tired, but it's okay. Don't worry. Don't worry about it. It's a financially free Sunday. Have a great day, and I'll see you on the next video.